Continuing the trend of looking at AI stocks, let's have a look at Nvidia. Of course, we have two of the major companies, Google and Microsoft, battling it out on the field of AI. But of course, as the famous saying goes, in times of a gold rush, the person selling the shovels is making the most money. So who exactly is selling the shovels for the AI transition that we see right now? We see two massive giants battling it out, and with what equipment are they going to do that? Of course, they're going to do that with graphics cards. And I think in the graphics card department, there are only three major players. There are Intel, AMD, and Nvidia. And when it comes to AI and high-end graphic cards, I think Nvidia is by far the top of the line here. They are most specialized into AI. So let's see exactly how well their shovel business is doing. And let's see how much money they're making from selling their graphics cards to consumers as well as to the big companies like Microsoft and Google. So they recently released their 10K for January 31st, 2023. So this data is very, very recent. So let's look exactly what's going on here. So looking at their revenue numbers, we can see a steady growth of about 20% every single year, starting at 4 billion, going all the way up to about 27 billion. Now this is a massive, massive increase, which is of course mostly fueled here by the GPU shortage in 2022, where we saw a massive revenue spike of about 60%. 60%, those are crazy numbers, but of course those numbers are not really sustainable. We saw those numbers coming down in 2023, and many people believe us to be in a downtrend when it comes to GPUs and chips. Intel, AMD, Nvidia, they've all been hit quite hard recently because the demand for chips is relatively low now compared to 2022. Nevertheless, a consistent growth of 20% is absolutely nothing to sneeze at, and very good for their top line. So let's now have a look at that EBITDA, which is the earnings before interest, taxes, depreciation and amortization. It's before any accounting gimmicks have an influence on these numbers. We look at the raw bottom line numbers. So in 2014 we see $740 million in revenue, which has risen all the way to about 6 billion here in 2023. Again, we see 2022 as a massive, massive outlier. Of course, they sold their graphics cards for, some would even say, artificially high prices, increasing demand by lowering supply, and selling a lot of graphics cards to the crypto mining industry. They sold a lot of graphics cards there. But of course, with the entire market sinking, including the crypto market, the demand for graphics cards is no longer that high as well. So of course, their sales will also plummet because of that. We see a relatively steady growing line, however, between 2014 and 2023, where 2022 was definitely the outlier. We see an overall EBITDA increase of 22.8% year over year, which are absolutely astounding numbers. And I think what we can also take away looking at their revenue as well as looking at their EBITDA is that their EBITDA is growing faster than their revenue, which means they're able to increase the margins of profit. If we quickly have an additional column here and we take this number and divide it by the revenue, we make it a percentage point, we can see exactly what their profit margin is. 21% here in 2023, and it was 18% in 2014. So slowly but surely they've been able to increase their margins even as high as 35% here in the mid of the decade. So now looking at that debt level, we can see that that's also been growing in line with EBITDA, in line with revenue by about 20% every single year. 1,400 million in 2014, about 10 billion here in 2023. They are high numbers, but they're not really risky numbers. And I think the moment that your EBITDA grows by 20%, it's completely okay to grow your debt by 20%. So I don't think this is anywhere near risky territory, but we'll have a look at that later when we look at the ratios. Looking at the cash on hand, we can also see that they've been steadily accumulating additional cash on hand in case there's any economic headwind or in case they need to do any sudden acquisition or development of a new project. We can also see that the cash on hand is higher than the debt that they do have. So if they want to, they can basically pay off that debt right now and not worry about it later, which is very nice and a very nice cushion again as an investor. Market cap has been increasing by 44% annually. I have never seen a company that grows that much in 10 years. 44% is an amazing return. 10 billion in 2014, 376 billion in 2023. And of course, we can see here that 2022 was a lot higher than 2023. So let's say if we take this number, what exactly do we get then as the total result here? Whoops, let's have a look. 614,599, an annual growth of 51%. Absolutely insane. Absolutely insane returns for anyone who bought Nvidia at the start of the decade. You would have made an absolute fortune from this stock. Enterprise value in 2014 was about 8 billion and about 370 billion in 2023. Of course, enterprise value is the entire value of the business. It's the stock price as seen on the open market, so as seen on the market cap, to which we then add the debt and we subtract the cash, and this gives us the entire value of the business. So now let's have a look at the ratios. EV/EBITDA, how many years of EBITDA does it take for Nvidia to pay back the entirety of their enterprise value? And we can see here they started at about 10 times, which I think is a very reasonable EV/EBITDA ratio. But towards the end here, 2023, we see an EV/EBITDA ratio of 65 times. I have never seen a company as highly ratioed as Nvidia is right now. I think these numbers are insane, and I don't even care what their growth numbers are. They are nowhere near worth 65 times. But we'll continue our look and see exactly what our future projections say about this. Because of course 22% annually is nothing to sneeze at, but 65 times EV/EBITDA is insane, absolutely insane. Net debt to EBITDA has always been steadily under the 2 times ratio, which they could pay off if they wanted right now, so Nvidia has basically no risk of bankruptcy. Looking at their cash flow, we can see a steady growing cash flow of about 21% in line with their EBITDA, which is very nice to see. It means that the accounting team is expensing appropriately. Capital expenditure, this is all the costs that Nvidia has to make to basically future-proof their business. It's any additional maintenance on their facilities, it is any additional company cars, it is the maintenance and purchasing of property, plant and equipment. Anything they need to keep on operating their business in the future. Because of course the current costs are all included into the cash flow from operations, and any future maintenance and other costs are included into capital expenditure. And we can see that capital expenditure has been going in line with their cash flow from operations, which of course is completely understandable as they're scaling up their enterprise, that they also scale up the costs that are required to maintain that enterprise. Free cash flow per share has been increasing by 20%. The amount of shares outstanding has been a bit wobbly over the past 10 years, I do have to say, but I think overall we see a trend of them staying around 2,500 shares. They buy back some shares every now and again, and they dilute some shares every now and again. I think especially if your share price is as high as Nvidia's is right now, I think it's completely okay to sell some of your shares to your shareholders, because you're making an absolute fortune while not diluting the share count too much. So power to them for selling some shares on the open market. Free cash flow per share has been increasing by 20% every single year. Of course 2022 still being an outlier here. 24 cents in 2014, $1.50 in 2023. And now we see the absolute growth story when it comes to Nvidia stock. In 2014 it was worth $4 a share, and it has risen all the way to $150 in 2023, where we see a very high number of $250 basically in 2022. Of course it's come down a lot since then, about 50% haircut on their share price in the past year, but we did see a very big rebound lately. So let's have a look whether or not we think it's an attractive buy right now or not. The free cash flow yield for the past 3 years has been around 1%, which is insanely low. It means it takes about 100 years of free cash flow per share to buy back one share that they have, which is a long time. Of course, growth is very much calculated into this company, so it won't actually take 100 years, because of course their earnings are growing, but with their current earnings it takes 100 years for them to buy back all the shares with their free cash flow. So let's try to forecast this business. Let's see if selling shovels in an AI gold rush is a very lucrative business or not. So for the past 10 years, they've been growing their EBITDA by 22%, even 23% for the past 10 years. But of course, we see very high numbers of 100% growth as well as low numbers of -20. This is because the GPU and chip market is known to be a relatively cyclical business, and it's also a very competitive business. The moment that you don't have a product that can compete anymore, you are very quickly losing market share, as we have seen with Intel recently. They have been losing market share like crazy for the past few years, and they are basically redundant in the AI narrative. Of course, the same can happen with Nvidia, so they spend a lot of money on research and development to try and maintain the edge that they have right now. But of course, it's still a competitive business and it's still a very cyclical business. So this will of course impact their numbers, but overall we see a 20% increase in EBITDA. So I'm going to give them this 20% here for the first year, and I'm going to reduce it by 0.5% every single year. Just to be a bit more conservative with my estimate, I'm still giving them high double-digit growth numbers, so I don't think it's misrepresentative of their future projections, because I think their future growth may very well look something like this. I'm also going to give them a 25 times multiple. Now I know, for the past 4 years they've been trading at more than 40 times EV/EBITDA, but I think those numbers are way overpriced and way too high and nowhere near reality. So I'm going to say I want to be a bit closer to 25, maybe even 30, to give them an EV/EBITDA in the future, especially as I expect their growth to come down a little bit. I expect a lower multiple in the future. Of course, 25 compared to 65 is massive, but I do expect it to contract, and I'd rather be conservative than be too optimistic here, especially because there's a lot of risk with this company buying it at the current EV/EBITDA ratio. This gives me an enterprise value 10 years from now of $738 billion, to which we subtract the debt, we add the cash, gives me a market cap of about $740 billion, divided by the amount of shares outstanding, gives me a stock price 10 years from now of $300. And I'm going to do the same here for the free cash flow model. I'm going to grow their free cash flow by 20% in line with their earnings as we've seen they have been, and reduce it by 0.5% every single year. I'm going to attach a 2.5% yield to this, which is lower than they've been doing for the past 10 years, but definitely higher than for the past 3 years. I think it's a conservative, but definitely not too conservative number yield to give them on their free cash flow. And with this free cash flow number, I expect them to give me a stock price 10 years from now of $307.66. So looking at the open market right now, I can buy as many shares as I want of Nvidia for $267. Taking both my projections of the enterprise value as well as the free cash flow model, I get an average share price of $300.16. With this, I expect a compounding annual growth rate on the stock market price itself of 1.1% every single year. But of course, we also have to include the free cash flow that Nvidia will be producing, presumably in the next 10 years, as projected here in our free cash flow model. And if we include this free cash flow, I expect an internal rate of return, an IRR, of 2.9%. Of course, on average, the stock market returns about 10%, so I think compared to the overall stock market, I expect Nvidia to heavily underperform the market. I think Nvidia is way overpriced, and I would not recommend anyone to buy this stock right now. I think a 65 times multiple is insane, and definitely not worth it. But of course, let's have a look if we actually change up their numbers. Let's say they will continue their massive growth and they will maintain a really high multiple. If I'm going to give them a 50 times multiple here 10 years from now, I remind you right now for the past 3 years they've been trading above the 50 times. So let's say their growth story continues. Let's say for the sake of argument their growth story continues. I'm going to give them a 50 times multiple, and I'm going to give them a 1.5% yield. This gives me a share price of $580 as well as $512 for the free cash flow model, at which point I expect an IRR of about 9.5%. But I think this is very much the best case scenario. I don't expect them to maintain a multiple of 65 or even 50 times for the next 10 years. I think it's way too overpriced, and I very much don't expect that. But if you do believe in the growth story of Nvidia and you do believe these multiples will stick, then you can expect an IRR of 9.5%. I definitely don't, so I will return these numbers to what I expect them to be, which is 3% IRR. So let's see what happens if the price goes up or comes down. I think even if the price comes down again by 30% to $192, I expect an IRR of 7%. As we can see in 2023, they already reached $140. So their share price has been increasing drastically for the past few months. But even if it goes down to $150 again, I still don't think it's necessarily a very attractive buy. So my recommendation, and this is of course not financial advice, is that Nvidia is way overpriced and you should not buy it at the current price. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!